As this consolidation comes, you might naturally think that there's going to be less competition, and that's bad news. But I think what Randall Stevenson just said is an important point. It's not the same old players who are involved with this. There are newer, bigger, more powerful kids on the block.
Yeah, the real competition is Netflix, Hulu, Amazon Prime. Now we're going to have Disney Plus. All of these technology companies, plus now Disney and NBC has already announced it's going to have a service where they're fighting for the battleground is getting you, if you're going to drop cable, is using one of those services or getting something in addition. So that's the real issue. In this case, Viacom and at&T, they need to be together. Viacom needs at&T's distribution, and at&T needs Viacom's channels, which are almost 20% of all the viewing.
Tuna, we talk about these 800-pound gorillas who are out there, the new kids, who have this endless amount of funding, but they haven't figured out how to make money on this stuff either. In a lot of cases, they're either giving it away or willing to take a loss on it. How long do you think the market will continue to go along with that and say, yeah, we believe in this, go fight, doesn't matter if you make money right now?
Well, I think the good news, Becky, is that every year we're seeing incremental progress in terms of getting to that break-even point. I think if you kind of rewind several years ago, I think everyone was experimenting with various business models and trying to figure out how to get to profitability. I think what a lot of these companies have figured out is that it's going to take some time. The technology seems to be in place right now. I think really it's a question of getting the business models properly aligned, right? Mm-hmm. So I think the key here is to continue to experiment. For example, advanced advertising is one way that some of these platforms are looking to monetize it, and we're seeing progress on that front. So to your question, investors understand that it's going to take some time. While we're seeing secular declines in traditional pay TV, mm-hmm. The good news is that the online subscribers are starting to partially offset. And we think that in the next 3 to 5 years, perhaps, on an aggregate basis, you're going to get to that tipping point where the increases in online subscribers are going to start to outweigh, the declines in pay TV, and investors will get more comfort when we get to that level.
Michael, that would be my point, though, right? To this point, I think it's been great for consumers. I have so much content, more than I could ever even imagine to watch. But is there a point where it's not willing to get, Wall Street's not willing to give the funding, some of those places shut down, and then all of a sudden this consolidation of power is bad for consumers? Do you see that, or is this just a whole new world and we're never going back?
Yeah, the consolidation of all of these companies has been going on for a long time, as well as the shutdowns have been going on for a long time. There's nothing new in this. In fact, at&T tried, then when it was DirecTV, tried the same thing with Viacom in 2012, and it didn't end well, because DirecTV lost a lot more subscribers. Right. So not only do I think this is going to be over soon, but the timing is fascinating. On Saturday night is Nickelodeon's big event, which is the Kids' Choice Awards. And so if the deal expires, then there's going to be a lot of consumers that are going to miss out. So this is going to get resolved. Yeah.
I wanted to start a different tack, Tuna, in terms of the new initiatives that all of these different media companies are going on, and it differs slightly company to company. But do you think at&T or Apple or Disney will get an earnings multiple or be thought of in the same way as Netflix by investors anytime soon?
It's an interesting question here, right? So I think investors kind of look at Netflix in a very different mindset from a valuation perspective compared to some of these, other giants. To your question, I don't think the PE multiple is ever going to get that. But I think the idea here is to understand that the more exposure you have to streaming, for example, Disney with the launch of that platform, the more you're essentially taking your own destiny into your own hands. And what that means is that gives you the flexibility to monetize your own content across a lot of platforms, more so than when you have it kind of, licensed all over the place. So the key here is for investors to understand that this pie is growing. The more that you invest in content, there's going to be short-term pain, but over the long term, the more that you gain subscribers or advertising, these are essentially higher margin businesses. Remember, when you have a company like Netflix, where essentially the costs are fixed, where you can leverage the content costs as your subscriber base grows. So I think the business model inherently is attractive. The key is to continue to grow and kind of get a growing piece of that pie. And all the companies you mentioned, I would argue, stand to benefit from this secular growth. There's going to be potential winners and losers for sure, but we think the formidable players
But it is a growing pie, but the competitors that are fighting for a piece of that pie are also growing in number. I mean, just this coming Monday, we're going to have Apple announce their streaming service. Disney is yet to launch ESPN, their Disney Plus. They already have ESPN Plus, and then we'll have NBC Universal as well as at&T launch their services. And I think the key question here is how many of these services are consumers really going to pay for, and at what point are we going to see people make some hard choices, and who's going to suffer? Is it going to be the traditional TV bundle? The reason why this debate is happening right now is because Viacom does not have the negotiating power because they're subscale compared to these other players.